All right. Well, hello, everyone, and welcome to this special presentation by the Hawaii International Real Estate Council. My name is Patrick O'Neill. I'm a principal broker at Luxury Homes International, and here today as the president of the Hawaii International Real Estate Council. We have two great speakers for you today. And while I think most of us are pretty familiar with 1031 exchanges and HARPTA-FIRPTA, we're going to discuss some of the nuances that arise when we're dealing with our foreign clientele. And I think that you'll find that pretty interesting. Big disclaimer here, I'm not going to read through the whole thing, but this is no tax advice being given today in its short nature or advice regarding the 1031 exchanges. I want to say a big mahalo to Crystal Bisay and Wendy Brown at the Hawaii Association of Realtors for all that they do to coordinate this event and all the things that they do throughout the years. Ladies, thank you very much. We truly appreciate it. And also a big thank you to the Hawaii International Real Estate Council board members. You can see their names up here for the time that they dedicate in putting these events together. If you are not familiar with the Hawaii International Real Estate Council, we present educational events throughout the year that are focused on our real estate industry, and in particular, dealing with foreign and international clientele. If you are a guest joining today, and I know there's quite a few, you've paid $20 to join. Well, we've got a deal for you today. If you just add another $10, you'll have full membership to the Hawaii International Real Estate Council for the rest of the year. Today's event will be free for you, as well as our other future events that are similar to this. Crystal Bisay will put her contact information in the chat. Please reach out to her or any of us board members, and we can get you set with that. So just another $10, guests, and you're going to have full membership for the year. So you might want to check that out. A humongous thank you to our sponsor, Guaranteed Rate Mortgage, which not only sponsoring this event, but sponsors events throughout the year and has committed for the whole year for the Hawaii International Real Estate Council for several years. And a face that you probably all know, senior president of mortgage lending, Mr. Leonard Leventhal. And Leonard, we're looking forward to maybe an update on rates, what's happening, and also if you could introduce your team, that would be great.
Thank you, Patrick. Along with DJ Dole, who I'm going to introduce in a minute, it's always a pleasure to be in front of the group to support your webinars, your CE classes, whatever it takes to lend support to the real estate community, especially to HIREC. We appreciate the introduction, Patrick. I'll do a quick market update, then I'm going to throw it over to DJ because our time is short. Right now, I would say the overall rate environment for the 30-year fixed is still somewhere in the low to mid sixes. It can dip into the high 5% rate, but it'll take some extra cost and buying the rate down. So overall, I'd say mid to low sixes is where we're at right now. Always check with us, because depending on your buyer's profile, credit score, property type, down payment, loan program, rates can technically be all over the place right now. So please check with us before making any assumptions on where the market is at, and we'd be glad to update for you. I'll throw my name and contact information into the chat after we're done. Please feel free to reach out to us at any time. And with that, I'm going to hand it over to DJ, who will share a few things with market and best practices. DJ?
Thanks, Leonard, and thank you, Patrick, as well. Good morning, everybody, and thanks for the opportunity to speak this morning. I just wanted to go over a couple of things that we've got going right now. We've got our same-day mortgage, which basically we can get you a conditional loan approval in 1 day after you go into contract, and in close in as little as 10 days, provided that we've got an appraisal waiver. I just completed one of those, and I can't tell you how everybody was completely blown away at how fast we got this locked up and done. Also, we've got a program that we're doing right now. A lot of people are worried about buying. They're worried about getting into these loans and then having to refinance later. We've got a program that's supposed to end at the end of this month, but I have a feeling they're going to extend it, which is basically a no-fee refi. So within the next 18 months, provided the rates go down, they can refinance with all the fees waived. So it's a couple of programs that we're trying to do to be competitive. We're also, as Leonard mentioned, we're thinking out of the box. I'm doing a lot of ARM programs right now, a lot of 5 and 7 year ARM programs. Those rates are down in the lower 5s, 5.5, 5 3/8. So there's a lot of play here right now. Again, it depends on the property, but and the borrower, of course. But you know, we're trying to do our best to get your buyers into homes as fast as we can with the lowest interest rate. So have a great class, and again, thanks for the time, and talk to you later. Aloha.
Aloha. DJ, thank you very much. We really, really, truly appreciate all that you guys do and all these sponsorships. So appreciate that.
Thanks, Patrick.
All right. Okay, well, let's continue on. If you have any questions at all, please submit those either in the chat below or to the Q&A. We're going to summarize the questions, and we will have a nice Q&A session with the two speakers at the conclusion. Most of you probably know Julie Bratton. She's a rock star in the 1031 exchange area. Julie has over 27 years of experience in the real estate industry. She's a vice president, regional sales director, and has managed the Old Republic Exchange office since 2001. Please welcome my longtime friend, Julie Bratton. Julie, great to see you.
Hello, how are you? Thanks for having me.
Great.
Okay, let me tee this up here and share it. Thanks for having me. Okay, I got a lot to say in a short period of time, so let's get to it. So an exchange, everybody knows exchanges here. Most people on this call are familiar with it, but foreign international clients can do exchanges. There are a few nuances, okay, but basically the rules are still the same. So I'm going to brush over those rules a little bit, and I'm going to talk about HARPTA and FIRPTA and how they relate to the 1031 exchange, but I'm going to leave most of that to Brad. And then a couple of common hazards and pitfalls that I want you all to just be aware of that matter in an exchange. So first, remember, a 1031 exchange is a way to defer paying capital gains tax. It's not I'm going to get away from paying tax forever. It is a deferral of tax, okay? And people are exchanging until either you move into a property, make it your forever home, pass away, your kids inherit at a step-up basis. I mean, that's kind of the only way to really get around it. But remember, these properties need to be held for investment or for productive use in a business or trade. So when I say held for investment, if your clients are selling or buying properties and their friends and family are living there for free or practically free, and your client gets audited, the IRS could come to the determination that you're holding it for personal use, okay, rather than investment property. So clients need to be mindful of that. They should probably be charging their friends and family some type of fair market value and rent. So if they were audited, it was a legitimate investment property on their tax returns. Okay, why do people do an exchange? They do an exchange because capital gains tax is fairly substantial. You have federal, which is 15 or 20%, depending on your tax bracket. Okay, you have state, 7.25% and above. You have depreciation recapture that's taxed at 25%, and maybe the affordable care tax, which is 3.8%. So it adds up, and it adds up quickly. So that's probably the number one reason why our sellers, international sellers, regular sellers, non-resident sellers, want to do an exchange, because they do not want to pay these capital gains tax. They want to keep as much, you know, to themselves and their families down the line. Number two, reinvestment into a replacement property, which allows the exchanger to leverage dollars that would otherwise be spent on taxes. To say this differently, it's like a free government loan. The IRS says as long as you follow the 1031 rules, you basically get to take all of your proceeds and roll them into your replacement property without paying the capital gains tax, as long as you keep it moving in the economy. Exchange of a passive investment into an income producing property is number three. So let's say your client has an investment property, it's just operating or performing just so-so. This is an opportunity for them to take those proceeds and get into a better income producing property. Or let's say this, let's say you have a client who owns vacant land. It sounds very glamorous to have vacant land, but you know what? Vacant land doesn't pay. So why don't you sell that vacant land, get into some income producing property or a better income producing property so you can pay for your aging parents' health care or your kids' tuition or take a great vacation in Tahiti. I'm just saying, okay? Get into a better income producing property. And then diversification of your real estate portfolio. Our clients can do an exchange anywhere in the United States, the US Virgin Islands, and Guam, just not Puerto Rico. So with our international clients, I know they get excited about selling and buying properties, but just be mindful or just know that all of the properties being sold and purchased need to be within the United States, the US Virgin Islands, and Guam. Okay. What qualifies as like-kind property? Like-kind property is any combination of real property. Okay, so single-family home, condo, vacant land, commercial building, any combination of real property that is being held for investment qualifies for an exchange. Okay, the rules of the identification have not changed. When clients identify property, they either identify under the 3 property rule or the 200% rule. The 3 property rule is just for 3 properties of any value. And the 200% rule is for 4 properties or more. So if you want to list 4 properties or more, you can, but the fair market value of that whole list, that entire list combined, cannot exceed double or 200% of what they sold their relinquished property for. So if they sell something for $1 million and they want to diversify and buy lots of properties, more than 4 or more, they can, but the fair market value of that entire list combined cannot exceed 1 penny over 2 million, because that would be 200%. So they can't go and identify an entire neighborhood and then pick one later. Okay. And the 95% exception is if they want to identify more than 200%, which is nobody ever does. There are 4 methods of exchanging. There's the delayed exchange, the simultaneous exchange, the reverse exchange, and the improvement exchange. The delayed exchange is where you sell first and then buy. The simultaneous exchange is when you sell and buy property and they close on the same day. We don't do many of these in Hawaii because of the good funds law. And then there's a reverse exchange, which is very popular right now, where you buy first and then sell. It's more expensive, but it gets you the property that you want up front first. And then there's an improvement exchange where you sell a relinquished property and you buy a piece of property that you want to build on or improve. What you cannot do is improve property you already own. You always have to buy new property in an exchange. So what are the rules? Properties need to be held for investment or for productive use in a business or trade. Primary residences do not qualify, and they must use a qualified intermediary, somebody like me. The IRS says you have to use a qualified intermediary in an exchange unless you're doing a true swap of properties. The exchanger is not allowed to touch any proceeds. So an exchange needs to be set up before escrow closes. And if you're dealing with a non-resident seller, HARPTA applies or could apply. If you're dealing with a foreign seller, FIRPTA might apply. So the exchange needs to be set up before the escrow closes, and the client has to understand what these withholdings are, which Brad is going to get into, but it has to be set up before escrow closes. It could be the day before closing, but it needs to be set up. And again, the client needs to identify what they're going to buy in writing to me on or before their 45th day. And they have to buy and close their replacement properties in 180. So this is the timeline. They have 45 days to identify what they're going to buy and 180 days to close on it. The timeline starts the day they close on the sale of the relinquished property. And there are no extensions, none. Good market conditions, bad market conditions. Everything that I put on my list is not available anymore. Okay. No extensions unless we are victims of a natural disaster that the federal government recognizes. And I'll give you an example of that. California has just been hit like crazy. There are 44 counties in California that are getting an extension on their 45 and 180 days till October 16th, if they fall under the affected taxpayer definition. So it's pretty crazy. But thank goodness in Hawaii, we don't have any natural disasters that the federal government recognizes. So this is the timeline, no extensions. One thing I do want to point out, though, is the 180 days. Our Hawaii contract says 180 days. You have to close on this date. But if it lands on a holiday or weekend, you can close on the following business day, not on an exchange. Your exchanger has to close on their 180th day. So let's say 180th day lands on Christmas. You might have to close on Christmas Eve or before that. You cannot bank on that language following business day on an exchange when you're dealing with your 180th day. So you need to be mindful of that. Selecting an intermediary, I want you to know this is an unregulated field and anybody can get a business card printed up and say they're a qualified intermediary, which is crazy. Your clients are handing over hundreds of thousands, maybe millions of dollars to a qualified intermediary that does not have to be licensed or bonded. Okay, so it's really important that you're selecting an intermediary that complies with the rules, has the financial security and the experience. I am going to pass this on right now to Brad because I did pull up a different PowerPoint and my other PowerPoint has a couple more things I want to talk about shortly. So can we hand that off and then at the end, I can go back on really quick and talk about a few extra things.
Okay, no problem.
Sure.
I'll go ahead and
Thank
jump in.
you.
I apologize for that, but
Yeah, no problem.
don't
And
worry.
Brad,
I got you covered.
Oh, good. And Brad, before you begin, let me just, I think a lot of people already know who you are. Again, I would say rock star in the HARPTA FIRPTA world. Brad Konishi has been a licensed CPA since 2001. He's the president and CEO of HARPTA Help LLC. Name says it all. Assisting sellers with related issues to HARPTA and FIRPTA. Brad, thank you very much for joining us, especially in the middle of tax season. So take it away, Brad.
Oh, thank you so much. And just to let you know, today is my 58th birthday. So if I break down crying in the middle of this presentation, maybe you'll understand why. So let's talk a
Well,
little
at least
bit
it's not your 60th, so you got a couple of years till that time.
I do. You know what? I'm sorry. My screen is frozen. Is the screen frozen for anyone else?
It is, but you look good.
Oh,
So do you want to try to share your PowerPoint? See if that will come up.
Sure. You know what?
This is
Okay.
Julie's.
It did start for a second. Okay. Do you want to continue? Okay, here we go. Okay. Let me go ahead and start this. My PowerPoint presentation. Okay. Can you guys see that?
Yes, we can.
Okay.
Okay.
Let me start right into it. So, HARPTA, where's my money? It's a question that we get asked a lot. So just a little bit about myself, CPA since 2001. Patrick kind of went over it. This is a picture that was taken of me before I had all my silver hair. So you know what? I'm going to skip this disclaimer because Patrick did a really good disclaimer right at the top. So let's jump right into it. Let's talk about HARPTA and FIRPTA. So first, HARPTA. HARPTA is actually an acronym. It stands for the Hawaii Real Property Tax Act. And essentially, and this is something that a lot of people get surprised about, is essentially the buyer is responsible for collecting the HARPTA. The buyer of Hawaii real property is required to withhold 7.25% of the amount realized from the seller and pay that amount over to the Department of Tax. And so sellers who are resident persons are allowed an immediate exemption from the withholding requirements by completing Form N-289. And I'm going to go over that form in just a little bit. So, can you guys see me okay though? It's just where I can't see anyone else though.
Oh, Brad, we see your PowerPoint, but your camera I think might not be working. So
okay, you know what? Let me stop the video and let me start it again. I'm not sure. There we go.
There you are. Yes, we can.
Okay, good. Okay, so HARPTA, one thing that's, and this is something that when discussing it with clients, I found puts their mind at ease. Explain to them that HARPTA is not actually a tax. HARPTA is a withholding. And so a withholding is an amount that's set aside by the government in anticipation of possible future taxes. So if a withholding exceeds the actual tax liability, and this happens a lot. In fact, this happens probably over 90% of the time that we talk to a client. When the withholding exceeds the amount of the actual tax liability, the taxpayer is entitled to a refund. Let's see. Okay, so all things being equal, and this is another thing that's important to explain to especially people who are Hawaii non-residents. All things being equal, a Hawaii resident and a non-resident will pay the exact same tax rate. It's important that the non-residents understand we aren't hitting them with any more taxes than we would a resident. The only difference is that Hawaii residents pay taxes on their worldwide income, whereas non-residents only pay taxes on their Hawaii sourced income. So, a lot of people complain about HARPTA saying, Hawaii is a tax hell, and Hawaii is. In many ways, Hawaii is a really taxes people really heavily. However, when it comes to real estate sales, there are a total of 16 states, 15 states other than us that actually have some sort of withholding. I think my video stopped, so I'm gonna stop that. I'm gonna start it again. I'm gonna see if that works. It doesn't seem to be working. Sorry, let's start one more time. There you go. Okay, so there's two ways to deal with HARPTA prior to closing. That's there's a form called an N-289. And they're going to get that once they go into contract from their escrow officer. So that, or if for some reason they can't get a waiver via N-289, they can apply for it and receive what's called a withholding certificate from the state of Hawaii. So I'm going to talk about that in a little bit. But after closing, there's two other ways to get their money back. They can file for an early tentative refund, or they can skip the early refund process altogether and just wait for tax season of the following year, and they can get a tax return by just doing a Hawaii income tax return. So before closing, N-289 I talked about, once again, they're going to get this from their escrow officer. If they're a resident person, they can check the first box. That's the resident person box. Second box is for if there's something called a non-recognition provision. And this is the box that Julie and her people fill out a lot, or help their clients to fill out a lot. This is getting an immediate waiver of HARPTA by doing a 1031 exchange, which is a type of non-recognition provision. But there are other types of non-recognition provisions that are also allowed to get immediate HARPTA waivers. When in situations where you have husband and wife who own property together and they're divorcing and one spouse is selling to the other, you have a situation where you might not have to recognize any kind of gain. So number two is for non-recognition provisions. Number three, don't see this used very often, especially not now, is for sales occurring less than 300,000. So this is the gross sales price is less than 300,000, and the home had to have been the seller's principal residence for the last year. So one of the questions I ask fairly enough, of course, is who is a resident person? Because resident persons are allowed an immediate HARPTA waiver. So any person who is domiciled in Hawaii and any person who resides in Hawaii for anything other than temporary or transitory purposes. And some of the slides I'm going to go over in just a little bit, a lot of words on them. So you know what? I'm not going to read the words. I'm not going to go over the entire, verbiage on the slide. But I've provided a PDF of these slides to Crystal. So if you want, a little bit more guidance than what I'm going to explain, Crystal will be able to give you a PDF of those slides. Just go ahead and ask her. So once again, domiciled in Hawaii or anyone who resides in Hawaii for anything other than temporary or transitory purposes. So a resident estate, essentially what this rule is that if somebody owns real estate and they pass away, if that person is a Hawaii resident when they pass away and own that real estate, their estate is considered to be a Hawaii resident. And so they get an immediate waiver of HARPTA by checking off that they're a resident. And these are for people who have estates. However, there's different rules for trusts. People who pass away and then their trust actually takes over ownership of the property. They're going to be treated a little bit differently. Their trust is a resident trust based on the residency of the fiduciaries, the trustees, and also to where the majority of the administrative work is done. So that will really determine whether the trust is a non-resident trust or a resident trust. So one thing that's really important to note about HARPTA is that a person in the military who is stationed in Hawaii, who does not declare Hawaii as his or her state of legal residency, and this is probably over 90% of the service members who are stationed in Hawaii do not declare Hawaii as their state of legal residency. If they don't do that, they are going to be a subject to HARPTA because they're not a Hawaii resident for HARPTA purposes. Military service members who are transferred out because of a PCS are not automatically eligible for a waiver. However, they can apply for it, and they can fall back on the rules of the main home gain exclusion. And if the main home gain exclusion allows them to get a waiver and completely waive all the gain that they have, then they can walk away from the transaction without having any HARPTA withheld. So talk a little bit about domicile. A domicile is the person's is what the person considers their true home. It's a place where the person plans to return to after they've maybe been traveling or they've been away for a little while. A person can have a number of different residences, but just keep in mind that they can only have one domicile. So generally speaking, when it comes to state taxes, any person can be a resident of any one state at a time, but they're generally not more than, they're not resident of more than one state. So although intention is a key factor in domicile, there must be evidence, behaviors that actually support that conclusion. You can establish your residency by physical presence, actually being physically present in Hawaii. But keep in mind that this is not allowed if somebody is present because of military obligations, or if they're present and they're present for temporary or transitory purposes. So this flowchart explains some of the options that a seller may have prior to closing. And I'm not going to go over all the boxes, but take a look at it a little bit later if you want. Crystal's going to send you this handout, and this explains some of the options that your buyers may have, or excuse me, your sellers may have. Caveat, and this is really important for the sellers to understand. In order to get a withholding certificate or any sort of refund, the sellers need to be current on all of their tax obligations. So they're going to hold your HARPTA money hostage until you do. Before closing, once again, you can also get a withholding certificate, which gives you a waiver of HARPTA. This is something that the state reviews. And if done properly, the state will give you what's called a withholding certificate, which will give the seller a waiver of HARPTA. So sellers selling the home for a tax loss, that will get them a waiver. If they're not going to recognize a gain because of, say, the main home gain exclusion, that's going to get them a waiver. Or sometimes the seller has insufficient equity in the property and they're being told that they have to bring cash to closing. If the seller is in that position, then they can apply to have HARPTA with reduced, so that they don't need to actually bring any cash to closing. So this is one of these options. Important to kind of keep in your back pocket, because if you ever have a seller who is being told that they need to bring cash to closing because of HARPTA and they just can't come up with the cash, you don't want HARPTA to really stop the sale. So just keep this option in your back pocket, because it's something that some realtors, can really stand to benefit from, sometime down the line. If a seller is getting a withholding certificate for HARPTA, keep in mind there is a deadline to file. That deadline is no later than 10 business days prior to the close of the sale. If they can't get a withholding certificate, that's okay. There are other options for them to get back their money. After closing, they can file for an early tentative refund. We help clients do that quite a bit. If they are filing for an early tentative refund, they can generally get their money back in about 60 to 75 days from closing. Or they can just bypass the early refund process altogether and just file a Hawaii income tax return for the year that they sell. And of course, if they want to get their money back sooner, the early refund is the answer. But if they don't really need their money right away, they can wait. Penalties for non-compliance, get asked this from time to time. There's some really, really harsh penalties for non-compliance. And the reason why is that there's, the dollar amounts for HARPTA, it usually starts off at somewhere around 35,000. We've had HARPTA withholdings that go over 300,000. So it can be an awful lot of money. So because of that, the state tax department does treat it pretty seriously. So let's talk a little bit about FIRPTA. FIRPTA is the withholding rate. A lot of people just assume FIRPTA is 15%, but actually FIRPTA can be as low as 0% for some people. For home sales less than 300,000, if the buyer signs certain affidavits agreeing to live in the home for a certain amount of time, it can be low as 0%. Any homes between 300,000 and $1 million, where the buyer signs an affidavit agreeing to live in the home for at least half of the time that it's being occupied, then they can be as low as 10%. However, in almost every single case of FIRPTA that we see, it's almost always 15%. Buyers rarely want to sign that affidavit. Who is going to be subject to FIRPTA? A foreign person, non-resident alien individuals. One thing to keep in mind, a foreign person does not include resident alien individuals. Green card holders. Green card holders are generally given a pass on FIRPTA. So ITINs, individual taxpayer ID number, and this is really, really important. We see this happen a lot. In order to obtain a HARPTA or a FIRPTA waiver or refund, any sort of treatment for HARPTA or FIRPTA refund or waiver, foreign seller must have an ITIN. The home seller needs to get an ITIN from a licensed acceptance agent. An acceptance agent is somebody that has a special license from the IRS to fill out what's called the W-7, which is an application for an ITIN. Acceptance agents are available in countries all around the world, and ITINs will generally be issued in cases where the applicant will need to file a tax return for the, for either the feds or for the state of Hawaii. Green card tests. If you are a green card holder, then a FIRPTA should not apply to you. Also, too, there's something called the substantial presence test. Somebody who is in the United States on certain visa types, and they're here for a certain amount of time. And I'm not going to go over the details of this substantial presence test, but if they're in the United States for a certain amount of time under certain visa types, they may be able to get a waiver of FIRPTA just by being here, just by passing the substantial presence test. And once again, this describes the actual test itself, but I won't go into the details because it's just, it really is interesting if it might apply to you. But for people who are, just kind of learning about the concept, it's not super interesting. HARPTA Help. HARPTA Help is our company. You can find us at harpta.com, easy to remember. Brad at harpta.com if your clients need someone to email, or we have our phone number. If your clients have any questions, give us a call. So let me stop the share and let me open this up to questions.
Great. Well, Brad, hold 1 second on that. Thank you very much.
Okay.
Julie, did you want to share something else before we went to Q&A?
Yes. Gosh, this is not mine. And I was bragging earlier that I had it all teed up.
Well, if you'd like, Julie, we can continue. We'll just do some Q&A with Brad.
Continue, and I will pull this up.
You
Okay.
take a look.
It's
Okay, so
very
Brad,
strange.
couple questions. And I'm consolidating everybody's questions, so hopefully we get to everything. Question number one, is a full tax refund filing needed to get the refund?
Is I guess is a full tax filing needed? I guess yeah, it's a good question, because technically if you file for the early refund after closing, you can get an early refund, but technically you're supposed to file in a Hawaii income tax return in the year you sell. So is it absolutely necessary to file that tax return to get the refund? No, it's not. However, you're legally obligated to file that tax return. So it's yeah, I guess that's the careful way of answering that question.
Okay, how about for FIRPTA?
Oh, for FIRPTA, once again, yes, it's similar answer. You might be able to get an early refund by filing what's called an 8288B. It's a form 8288B. What will happen is you file that with the IRS. The IRS makes a determination how much the seller is able to keep and how much should be sent into the IRS, right? So that's kind of like a quasi refund. If they do that, yeah, you could probably get away with not filing your federal income taxes. But because you had a real estate sale in that year, you're legally obligated to actually file that income tax.
I see. Okay. And I know you touched on this. This comes up quite often where the seller has financing on the property and does not have enough cash for the HARPTA FIRPTA exemption. I know you touched on that.
Yes.
Is that often given the reduction or the exemption on that?
Yeah, it is. It is. I think last year we had probably 18 filings like that. We had just a whole number of filings of people like that. And it didn't happen a lot during the first half of 2022 because the prices were so high, right? But then prices in certain neighborhoods, certain areas started dropping a little bit because of the interest rates in the second half of 22, early part of 23. And because of that, we saw some people running into a situation where they just didn't have enough equity. And once you slap that FIRPTA and HARPTA onto it, well, it wasn't so much the FIRPTA. Well, we saw a couple with FIRPTA, but it was mostly HARPTA. And then, they were put in this impossible situation where it's like, okay, well, if you want to sell your house, you got to come to closing with $15,000 or $20,000 or whatever it is, right? And of course, a lot of times these people are just trying to get out from under the house. They just want to get this sold and get out from under it because maybe they have a negative cash flow from their rental activities. It's possible. So in those kinds of cases, they just want out. But what we do is we've gotten HARPTA reduced. We need at least 10 business days prior to closing to file. But we show the estimated seller statement. We show at the very bottom, there's a due from seller. In other words, the seller needs to pay in order to sell this thing. Once we show that, we can get that amount reduced. And a lot of times the seller can go to closing and they don't need to pay any cash. So, that's a very big benefit if you have a seller in a difficult position like that.
Yeah. Okay. Excellent. Julia, how are you doing on your tech over there?
I think I got it.
Okay. All right. Why don't you share your screen and you can finish up your presentation.
I think I got it. Can you see this?
Nope.
Not yet. Nope. Hit share screen down below and then you can select it.
On there.
You have to open it first, open the file on your computer, then come back to Zoom.
Which I did.
You got to give me another question, Patrick?
Yes, please.
Okay.
Yep. Let's hit another one. So Brad,
Julie got a screen sharing.
can you see your desktop?
Keep talking.
Okay,
Give me
okay.
Keep talking.
I can just talk without it.
Okay.
And share it.
Okay. Why don't you do that, Julie? Why don't you
Okay,
talk
sorry, you
about
guys.
it?
I don't know. It's so silly.
It's all right.
I really did. Actually, here it is.
All right. Okay.
So embarrassing. Okay, I'm picking up where I left off. Okay, proper exchanges. We're going back to exchanges a little bit. So
Okay.
property that does not qualify for an exchange is going to be stocks, bonds, securities. Remember, personal residences do not qualify for an exchange. Okay, you with me?
Yes.
One thing I'm getting a lot of questions about is interest in partnerships. If your client sells a piece of property and wants to buy another piece of property, we're at the bottom here. Let's say Patrick and Brad and I own in a multi-member LLC. Okay, and somebody wants to do an exchange and buy into our property. They can buy a percentage of that real property, but they cannot buy an interest in the entity that we have that owns the property that they want. Okay, so common pitfalls. I just really wanted you guys to be aware of this. how people hold title to property that they're selling actually matters. And we're going to get into this in a second, because let's say you have, let's say my sister and I own a property. I live in Hawaii and she lives in California. Maybe half of the transaction is going to be subject to HARPTA. Or maybe half of the transaction is going to be subject to FIRPTA. And escrow really needs to know about this up front so we can give them the proper information and documentation for them to figure out how they're going to proceed. It matters if people are married or single. We do not live in a community property state. So when I set up an exchange and I get a copy of the contract and the title report, I need to see who's on title and who can move forward and who cannot. Partnership interests. If you have clients that own properties in a family trust or a formal partnership or a multi-member LLC or a corporation, you know, that entity owns the property, not the members. So they cannot move around independently as they want when they want to, tax-free. So let's say there's 5 kids or 5 guys, partners, and one wants to go their separate ways. They can't do that tax-free. Okay, so that these things really matter in an exchange. So that's why I bring it up as a common pitfall, just to be aware of. If a client wants to sell and they own properties in some types of entities, we really need to know about this up front so we can figure out how they can, you know, move forward with the least amount of tax exposure possible. There's seller financing. Okay, so if a seller wants to sell their relinquished property to, let's say, their tenant, and their tenant can't afford, you know, one of Leonard's, or can't qualify for one of Leonard's loans for some reason, seller financing can be part of an exchange. I think that's the last ditch effort, but I want you to be aware of it. Related parties matter in an exchange. So FIRPTA, Brad pretty much went over all of it, but I just want you to know if a seller is selling an investment property and they are a foreign seller, escrow is going to be required to collect the FIRPTA. 15% of the sales price. I will give you the problem and then I will tell you the solution. If escrow takes some of the proceeds or a portion of the proceeds to satisfy the FIRPTA withholding, then am I, the exchange company, getting all the money? No, because escrow had to take a chunk of the proceeds to satisfy that withholding. And now we have a client who needs to buy and close on his replacement property in 180 days. The exemption hasn't come in yet, and the money cut hasn't come back because Brad's working on getting this refund. Okay, so now the client is short money to buy that replacement property. So the client either has to bring in fresh cash or get a larger mortgage amount to complete his closing. Here's the problem. When the client's exemption comes in and they get their refund back, what are they getting back? They're getting back exchange proceeds. And remember, you're not allowed to touch exchange proceeds. So those exchange proceeds are exposed to taxes. We want to do an exchange so we don't have to pay taxes, right? So the way around it, the solution, if the foreign seller can do this, and they usually do, the foreign seller should bring in fresh cash to escrow before they close on that relinquished property to satisfy the withholding. Therefore, escrow can send me all of those exchange proceeds so they can timely purchase the replacement property. Then when the exemption and the money come back, what is the client getting back? They're getting back their own money and it's not taxable. Okay, so foreign sellers can do exchanges, absolutely, but they have to jump through this FIRPTA hoop. Okay, so remember, if you have a client who is selling their relinquished property and you think they're subject to FIRPTA and you're not sure if they're subject to FIRPTA, you don't know, we need to have them talk to escrow or me or Brad to see if it's going to apply to them so they understand what the rules are. Maybe half your transaction is subject to FIRPTA. Maybe you have an American husband and a foreign wife or vice versa. You know, escrow needs to know about it so we can advise them properly. HARPTA, Brad went over very well also, but how does it relate to the 1031 exchange? If a non-resident seller sells property in Hawaii, they are subject to HARPTA, which is 7.25% of the sales price. of the entire sales price. But if they do an exchange, they will be exempt from that withholding. So if the non-resident seller tells escrow and fills out those forms and says, hey, I'm going to do an exchange, fine, escrow will not collect. They will send us, the exchange company, all of the money so we can timely purchase their replacement property. Now, if a client decides somewhere within his exchange period, he's not going to do an exchange, forget it, I'm too stressed out, I cannot find a replacement property and wants to cancel, that's fine. But I become the withholding agent at that time and I have to collect the HARPTA. So they don't get away with it by telling escrow, I'm going to do it. Escrow will never know. Let's send the money to Julie and then I'm going to cancel. Like I am still obligated to pay HARPTA if it is required. Let's say you have a client who says they're going to do an exchange. All of the money comes to us and they buy some replacement property. And let's say there's some money left over. If there's money left over, I still have to collect HARPTA. I only have to collect it on the money that's remaining in the exchange account. I don't have to collect it on the entire sales price. So it's kind of like partial exchange, partial exempt. But again, HARPTA does apply to non-resident sellers. And maybe you have a transaction like my sister and I live here, she lives there. You know, we might have to collect HARPTA on half of the transaction because, you know, I'm the smart sister and I'm doing the exchange and she's, going to pay taxes. Okay, so it's these capital letters, HARPTA and FIRPTA, are very important to identify early on in the transaction so the client understands what they mean and what it means to them from a tax perspective. Because it's nothing like it, there's nothing like them seeing these capital letters on their statement right before closing. Okay, related parties, I do want to bring this up really quickly. IRS does not like related parties. You're going to get this slide, so I'm not going to go over it in depth, but when I talk about related parties, I'm pretty much talking about immediate family, mother, father, brother, sister, okay, spouses, and entities also fall under related parties. So just so you know, aunties, uncles, in-laws, exes do not fall under the related party rules. So when I set up an exchange, I'm always asking the client, if you are thinking about selling to or buying from a related party, we need to have a conversation. You know, one time I had a transaction, there was 8 Lees, L-E-E. I called them all, they said they weren't related. I said, okay, I asked. Okay, so it's really important that these kinds of things come up. So this is another common like little hazard. And sometimes I only find out about it because I look at the contract and then I see all these Lees. Okay, so that's why I do ask it when I'm interviewing them. Non-exchange expenses. Okay, the best way I can tell you is allowable expenses on an exchange is commissions and escrow fees for the most part. So the one thing I really want to point out to you guys on this call is credits. When your clients are doing exchanges, credits are considered a non-exchange expense. So if you can, you should adjust the sales price to accommodate the credit or handle it outside of escrow. The reason why it is a non-exchange expense is because number one, it's not defined as a customary closing cost like commissions and escrow fees. And number two, it does not need to be done to convey clear title to the new buyer. It's just a negotiating tool. I mean, if you have the credit, if you don't get audited, it works. If you get audited, the IRS could highlight that line item and call it a non-exchange expense, and then that line item could be exposed to taxes. So I know that is something you all do in your everyday business, but I want you to be mindful. Sometimes these things don't jive with an exchange. So we should just, if you're not sure, ask. Okay. Constructive receipt. Remember, client can't touch any of the money. So if the relinquished property closes and the client did not set up the exchange, they will be in constructive receipt of their money because escrow will have dispersed to them. We don't want constructive receipt in an exchange. So lastly, the qualified intermediary, what we do, we handle the whole 1031 exchange. We draft all of the exchange documents. We coordinate with escrow. We review the contracts, the title reports, the entity docs. We wire funds. We hold money. We track your identification notice. It's a big orchestration of things that need to happen for a successful exchange. So, there you have it. And I already talked about selecting a qualified intermediary, that it is an unregulated field. And anybody can have a business card printed up. So I've been with Old Republic Exchange for 23 years. We're having our 30th birthday though this year. Old Republic Exchange has been in play for 30 years. This is awesome. And we can also say, which we're super proud of, that out of these 30 years, we have not had one exchange fail on an audit for something that we have done. And we are really.
Congratulations.
So anyway, okay, sorry about my PowerPoint issue, but
No, you're good. You're
Patrick.
good. No, we really appreciate it. Okay, Julie, let me ask you some questions, and then Brad, I'm going to come back to you because a couple other questions came in. Okay, first thing, Julie, I just want to clarify and underscore this again. 1031 exchange may provide an exemption under HARPTA, but does not provide an exemption under FIRPTA, correct?
Not entirely. If you do an exchange, you're exempt from HARPTA. If you do an exchange, you will be exempt from FIRPTA, but you're not exempt until the exemption comes in, which takes 120 to 180 days. That's why escrow will be adamant about collecting it.
I see. So here is the whole story of bringing in the cash to close that, then file for your exemption. Okay, thank you. Next question. If there are two sellers on a property, can one do the 1031 exchange?
It depends how they hold title. So let's say it's my sister and I, and we're joint tenants or tenants in common, then yes, we can go our separate ways. We own our undivided interests. But let's say the property that's being sold was, a family trust, and my sister and I were the beneficiaries. The trust owns the property, not Jenny and I. So the trust sells and the trust has to buy. We cannot go our separate ways.
Okay.
So it will depend how title is held.
Okay, and this will be a little related. Sole member LLC.
Single
Now,
member LLC.
Single member selling the property. When they purchase the replacement property, it needs to be in what name?
If it's a single member LLC and it's disregarded for tax purposes, which they usually are, they can take title in that single member LLC or their individual name.
Great, okay. Okay, I think you touched on this, but this was a question. If a seller uses the HARPTA FIRPTA, if they are going to do the 1031 exchange and looking for the exemption from HARPTA FIRPTA, you're holding the funds. What happens if they do not close on the replacement property?
Well, FIRPTA will have already been collected, so I don't have to worry about FIRPTA. But if they do not buy a replacement property, then I have to collect 7 1/4 of the entire sales price out of the proceeds that I'm holding. And then the remainder of the funds will go back to the client.
Okay, so it's not.
And then the client will, and then the client, like Brad said, will file for a refund if they've overpaid. And like he said, HARPTA is not, I'm going to take your money forever. It's just a withholding. Once you figure out what your true gain is, you file for a refund for what you're entitled to. I mean, people think it's like, it's so difficult to do business in Hawaii. It's not. At the end of the day, when it all washes out, they're paying taxes just like the rest of us. Hawaii just wants to be covered, and that's why they say collect upfront.
Okay. Let's see. Could you touch on the DSTs, which are becoming I think a popular exchange?
Yeah, so a DST is short for Delaware Statutory Trust, and it is a viable option for a replacement property. So let's say your client sells a relinquished property, they need to identify what they're going to buy in 45 days. Maybe they want to buy a house, maybe they want to buy a condo. Maybe this DST is a great backup. It might be not even a backup, it might be something people are really interested in. So it's really like a percentage interest in some type of category, whether it be like student housing or medical or storage or an Amazon building. And you will own a percentage interest with, 500 owners. Okay. And you'll get a check every month. And the only thing about the DST that people do need to be mindful of, they shouldn't be looking at it as a liquid asset. Like they could sell at any time. They should look at it as a long-term hold, 3, 5, 7 year. And then when the DST decides to sell, then you are selling your interest, and then you can decide, hey, I like this setup, I'll do a DST again, or you can go back and buy a condo or a single family home or whatever else you want to buy. But it is becoming much more attractive because it can handle your debt relief. you can get a check every month and you don't have to deal with, tenants and trash and all that kind of stuff. So people are coming around. I think it's been quite the paradigm shift or a shift in thinking, because I think most investors who are just selling onesie twosies, they're so used to driving by, smelling, touching, feeling the property. And this is such a hands-off asset. It's a little nerve-wracking. But now that it's become more popular and people are able to talk about it and talk about their experiences, I think people are warming up. So it is.
And do you see that? And do you see that becoming more popular with the Hawaii exchanges?
Yes, it's not a craze, but people are paying attention and learning about it and doing it more often, definitely.
Okay, great. And Brad, are you
Yes.
still there? We have a question
Yes.
for you.
Yeah, go ahead.
I'm assuming this relates to HARPTA. What happens if a Hawaii resident dies and leaves to a non-Hawaii resident? And I guess we could also say the same for US versus foreign.
Yeah, no, that's a that's a good question, and it really depends how the home is titled when it's actually sold. So, we run into this situation quite a bit when if somebody is a Hawaii resident and they pass away without a trust, what happens is the estate is considered to be a resident estate, and they're given given a pass essentially for HARPTA. So if the estate is still holding the real estate when the real estate is sold, then of course, it's exempt from HARPTA immediately because it's a resident estate. However, if, the beneficiaries receive the property, it's actually distributed to them, and then the beneficiaries sell it. I mean, they still get that step-up basis, but because they may not be Hawaii residents, they may be subject to the HARPTA. So, it really depends on how the home is titled when the home actually closes.
Okay, great, thank you. Julie, back to you. Do 1031 documents need to be notarized?
No.
Okay, and does
The only document that we need notarized is if there's a closeout, let's say there's a failed exchange or there's money left over and we're going to wire it back to the client. We require that document to be notarized because we don't want to send it to an imposter.
Okay, and Julie, again to you, when would you have to pay the deferred taxes, either from a single or multiple 1031 exchanges? What events would trigger that?
Once you sell the asset. So let's say I sold a piece of property for 200,000 and I did an exchange, and then I bought something for 500, and then I sold that for 500. I did another exchange. And now let's say I own a piece of property that's worth 1.2 million. And the market crashes. And I'm like, I'm not making any money. I'm taking a loss. I'm just going to sell my 1.2 property and be done with it. You can't just be done with it. Okay. If you sell that asset, that's when the tax is due. And not only is the tax due, the basis of the first property you did an exchange with follows you around. Yep. So that's why you pretty much keep it rolling. And then when you pass away, the kids or whoever is going to inherit it at a step up in basis. They will not inherit the tax burden, the capital gains burden. They'll have to pay estate tax, but who cares? They just got a property. It's gravy.
Okay.
And by the way, I'm adoptable if anybody wondering.
Okay, and Brad, back to you, and this I can relate to. This happened to us. The IRS requires the buyer's Social Security or ITIN, right, for filing. You're smiling already.
Yeah.
What to do if it's after the fact and the buyer is not cooperating and refuses to provide that?
Okay, here's the thing. We've run into. I think for some reason this has become a more contentious issue because I've been having to answer a lot of escrow questions about this. So one thing to understand is that the buyer and the seller are not obligated to release their Social Security numbers, ITINs, FEINs to each other. They can keep it secret if they want. I know a lot of tax professionals dispute this, but I haven't seen anything that requires them to do this. And so here's the thing: is let's address it first with HARPTA and then with FIRPTA. So with HARPTA, if the seller wants a refund afterwards, they don't need any sort of identification number. They can just file for the refund without the identification number. If they want a waiver before, they need the buyer's last four of their social security number. So that's all that they need. This is for HARPTA. For FIRPTA, it's a little bit trickier because here's the thing: is if the seller wants to file for a withholding certificate, which is a waiver prior, to the actual close, or some sort of distribution of the money after close, they will need the full buyer's identification number, full social security number or ITIN. However, if they bypass the early refund, they wait until next year, they do an income tax return. If they e-file, if they want to e-file, they'll need the buyer's full social security number or ITIN. However, if they paper file, they don't need that number. So that's kind of the difference. That's why when it's a situation where the seller is refusing to release that information, or the buyer is refusing to release that information, I tell the seller, just do a paper filing in the following year and you can get your money back that way.
Oh, good. Yes, Julie.
Brad,
Yes.
in your experience, after let's say they go through the exchange, they file for the exemption and they get their exemption, that's like 120 to 180 days. That's like 6 months, takes a long time. After you get that exemption and they go get how long till they actually get the refund?
Till they get the refund. Yeah, that's a good question. You know what? Once they get the actual letter from the IRS telling them how to divvy up the money, and they do that, they can usually get their money back in probably about maybe 2 months. So it's usually fairly quick at that point. It just takes a long time for the withholding certificate to be approved.
Right.
Yeah.
Okay.
Like 6 months or so. So we're almost looking at an 8 to 10 month process.
Probably, yeah. It takes a while, and it didn't used to be this way. Just to let everybody know.
Yeah, it used to be shorter.
Yeah, it used to be much shorter. It's just over the past few years, combination of budget cuts and COVID have caused the IRS to become like a logjam. Things are just sticking and not getting processed. So, yeah,
Okay.
it's tough.
And I know we're running a few minutes over, but let's keep going because it's too good. Julie, can you explain how the April 15th tax filing deadline can affect the 180-day period?
Yes, sure. That's a great question. So and this is every year, if a client closes on their relinquished property, the property they're selling, the date changes every year. It could be October 16th, 17th, 18th, depending on the year. Let's just call it 16th for this example. If they close between October 16th and December 31st of any given year, their 180 days gets cut short if they file their taxes on April 15th. But they are entitled to their full 180 days. So if they need it, they have to file for an extension and give it to us. And then we'll calculate what their 180th day is, and that's fine. They just can't file their taxes until they purchase the replacement property.
Okay, got it. And Brad, can you come back on? I've got one last question for both of you.
Okay.
Brad, your top 3 tips, heading into an escrow to prepare for the HARPTA FIRPTA preparation, what would those be?
Okay, top 3 tips. First one would be to make sure to contact your tax professional if you plan to work with a tax professional to help you get a waiver or a withholding certificate for either HARPTA or FIRPTA. Contact your tax professional as soon as you accept an offer, because there's
Can't they call you?
Yeah, well, yeah, they can call me. That's a good one. Yeah, call me as soon as you accept an offer. If you wait too long, you might get into that block of time where you just can't file because there are deadlines to file. So that number one. Number 2, just make sure you're organized with your paperwork. I think that's something that's really super important for all kinds of tax filings. And then number 3 is just have that understanding of HARPTA and FIRPTA are not taxes, they're withholdings, and you're probably going to get most of it back, if not possibly all of it back. So don't be too stressed about it. That's the one thing, because it seems to cause a lot of aggravation to sellers. So I think that would probably be my 3rd tip.
Yeah, and I hear that all the time overseas. You guys have those other taxes, and I'm not going to buy any. We have to explain it's withholding, not a tax. Okay, Julie, your top 3 tips to prepare for the 1031 exchange at beginning of escrow.
Gosh. Well, actually, one of my first top tips for when you take a listing, you should know whether or not you're about to list an investment property. And I really, really think you should be bringing it up when you take the listing. Because a lot of clients have never done an exchange before. They don't know about HARPTA. They don't know about FIRPTA. They have no idea what their tax hit is going to be. They just think they're going to make a lot of money and this is great. So they need to get educated. So as soon as you get the listing, you should be bringing it up. Number 2, yes, Brad, talk to the CPA, talk to a tax professional. You know, we all have our roles. Like I can't give tax advice. That's for a CPA, and a CPA can't be a qualified intermediary. Okay, we have different roles. We can work together, but I think it's really important that a client does figure that out. And also another thing, really managing clients' expectations about finding a replacement property, especially in this last couple of years and this market. Clients are stressed. And, you know, we are in the job, our job is moving people forward, getting them from point A to B with the least amount of stress possible. So managing expectations, like taking them shopping earlier for what they, you know, to weed through the properties they like, they don't like. So when they're in their 45 days, they're feeling comfortable. I think that's just really golden. Clients
Okay, great
need a
advice.
little bit extra hand holding.
Great advice from you both. And Julie, a vanilla 1031 exchange, what's the approximate cost?
Vanilla, let's say vanilla, $950 when you sell the relinquished property and $575 when you buy the replacement. So our fee is you pay as you go. For example, if
Okay.
you don't find anything, obviously we're not going to charge you the $575.
Brad, your question's probably more complex, but in a very easy, normal, vanilla HARPTA FIRPTA, if there is such a thing, exemption, what do the fees generally run?
Okay, no, so good. Waivers, HARPTA waivers are $900. HARPTA refunds are $1,000 for the first person on title, $500 for each additional person on title needing a refund. So husband and wife, unfortunately, we can't do it combined, but we can do 2. It's going to be about $1,500. For FIRPTA filings, generally speaking, $875 per person. So that's the approximate cost for the vanilla.
Wow.
Yeah.
And I want to
Reasonable.
just mention that, I mean, whether you're working with Brad or whoever, it is worth every single penny to have somebody help you with these refunds, because sometimes these forms appear to look easy, but if you make one mistake or you leave out one point, you have to start over. And that is very painful.
Yeah,
So
that's
you need a tax
very good
professional or
advice.
somebody like Brad to do it. I mean, people, they're like, oh, $800, I'll just do it myself.
Right.
I'm telling you. They need someone.
Yeah.
It's just
There you
one
go.
item. You start at square A, B, A, 0 again. It's just not
True.
fun.
Very true. Did you want to add anything to that, Brad?
No, I just want to reemphasize Julie's.
Well, then allow me to add a.
I mean, they're going to be pissed at Brad, and he didn't even do anything yet.
That's right.
It's just the whole thing, the whole process.
Yeah. Well, Brad,
Come to
Julie,
him or me upset, and like we don't know what we don't know.
All right. Well, Brad and Julie, thank you very, very much for your time today and all the knowledge. And I know there might have been a couple of questions we didn't get to. Please feel free to reach out to these 2 experts. They are rock stars in the industry. If I've got any questions, it's who I call. So these are the folks. And a real big thank you to Guaranteed Rate. Thank you guys so much. Wouldn't be possible without you. And for those of you, again, if you are a guest joining today and you paid your $20, just another $10, you get full membership for HIREC for the year, and the next events will be free. So thanks, everyone. Stay safe, happy selling, and aloha.